Hello, my name is Patrick.
Hi, I'm Ayush.
Today we're going to be going over financial analysis of the 10 companies that we have chosen. We decided to do our two industries as tech and healthcare. For healthcare, we chose CVS, Johnson & Johnson, Pfizer, Quest Diagnostics, and United Healthcare. For tech, we chose Autodesk, Google, Meta, Microsoft, and NVIDIA.
So we went through 5 of the methods for analyzing these companies. The first one is short-term solvency. We went through looking after their short-term debt and their ability to pay. We went through long-term solvency. We went through asset management. We went through profitability, and at last we went through market value.
Starting off with technology, we started with short-term solvency using the cash ratio to kind of compare and contrast them. Based on our graph right here, as you can see, NVIDIA was the big leader for a while by a lot, and then it shot down in 2023 and has once again taken its point, but not as dominant. However, we see this as a good thing, showing that they have a good amount of money to cover any short-term solvencies, as well as any obligations they need to cover in the span of a year. We didn't want them to have too much based on idle cash and them not making profit from it. For long-term solvency, we use the debt to equity ratio. Most of the companies are down here showing that they have a good ability to pay their debts in the long term. For the amounts that they have, Google is doing the best overall for the 5 years that we have shown, with NVIDIA not too far behind, in fact declining still. This shows that they have a good amount of leverage, financial leverage, showing that they're relatively safe in investment-wise for money long-term and not defaulting on their loans or anything as such. For asset management, we use total asset turnover. As you can see, NVIDIA has a clear jump on everyone else regarding 2023 to 2025. Most of the other ones are considered still going as normal, pretty similar. This is meant to show how efficiently they are able to move inventory, make sales, and get that profit back and not sitting in a warehouse. For profitability, we want return on equity. We wanted it to be our baseline. This is what we wanted to kind of base a lot of our information on. Because if your company is not making profit, is not returning to its shareholders, the company is not going to do well no matter what. As you can see, there is once again a big leader with NVIDIA, following from 2023 to 2025. They are showing that they are efficiently managing their investments from the shareholders, as well as their EBIT margin, showing that they have good operation profits. For the market value, we went ahead and used the price-earning ratio. We wanted to show that the market finds that all companies are fairly valued, which luckily we believe that they are all. As you can see, NVIDIA had a jump, but it was brought back down to be more in line with its value compared to the market. This is a little summary and kind of the winners of each category that we went with. We chose NVIDIA for its short-term growth and ability to cover any obligations in the short term. Google, based on its consistency throughout the 5 years for long term. NVIDIA has a much better total asset turnover than any other company on the graph. Same thing with profitability. For best market value, we went with NVIDIA and Microsoft because Microsoft has been very consistent throughout the past, even past the 5 years, they have been very consistent. And NVIDIA has had a large spike in growth, showing a large amount of growth, meaning that its higher value in the market is fairly valued. As such, we have chosen NVIDIA to be our best tech company, showing the large amount of growth, a large amount of profit, and a large amount of total asset turnover, showing that it's growing, it has a lot of risk to it, but it has a lot of chance to grow.
Yes, so likewise, moving on to healthcare industry, let's talk about the short-term solvency first. We choose cash ratio to look after their short-term solvency. Either they can meet the financial obligation in short-term or not. So looking at this trend, we can see that Johnson & Johnson, they are like in top. So they have a little more cash than that of others, so they can meet their financial, obligations, any financial obligations in short term. They are more liquid, so in short term there is a clear win for Johnson & Johnson. So moving on forward with long-term solvency, here we have debt to equity ratio, and debt to equity ratio shows that how much debt and how much equity are like structured in a company. So it shows that CVS has more debt than that of equity, and then like it shows Johnson & Johnson has not much of their capital is coming out of debt. That means they have a fair and they have a well structured capital structure. So the debt to equity ratio is lower. That means it's good, and not only that, like we also have to look either they can afford it or not. So looking at times interest on ratio from Bloomberg Lab, we see that Johnson & Johnson are doing good there. They have they have adequate fund to pay their interest, so that is a good sign. So for long-term solvency, I believe Johnson & Johnson can, it's less riskier and they can meet their obligations. So moving on forward, we have asset management in our healthcare industry. Like we are looking after total asset turnover here to see whether the assets are fairly managed or not, and whether the assets are like generating revenues, are like helping to generate cash flows or not. So looking at this chart, we can see CVS, they are doing good in asset turnover. Likewise, Johnson & Johnson, Quest, and then Pfizer, they are like doing a little below them. But it is a healthcare industry. We know that the huge investment in asset is done over machines, which are like which gives us constant return. Not it's not about selling product. It's about selling services. So I believe this is less impactful in healthcare industry, but still like CVS is a winner over here. And we have a next mode, that is profitability. So for looking after profitability of companies, we choose ROE, that is return on equity, to see either they have good return on shareholders equity or not. So looking at this chart, it shows that Johnson & Johnson, they are doing good after 2022. They are like doing good and they are on top of the other companies. So they are having much more return than other industries. They are more profitable. We also have to look after EBIT margin and then financial leverage while we look at return on equity. So we looked after that, and then we got that there is a better EBIT margin in Johnson & Johnson than that of like others. So they have good EBIT margin and they have financial leverage low. So that says that this company, Johnson & Johnson, is doing good. Their profit is driven by operations. So next we have market value, and we choose a price earning ratio to look after their market values. Either they are overfunded or underfunded, or they are fairly funded. So here we can see Johnson & Johnson, they are kind of fluctuating, but very small fluctuation we can see in them. But United Healthcare has a big fluctuation. So as a whole, we can see that Johnson & Johnson is leading at 2025, and it's more consistent, more stable. So and it also says that whoever has a better growth and then better outcome, better profit, their PE ratio are like fairly valued. Even though if they are high, like if they are low, then that's undervalued. But if they are high and they are doing good in profit term, then that's fairly valued. So here we can see Johnson & Johnson is at top, and their profit is also high. So I believe Johnson & Johnson's market value is fairly valued, and they are leading here. So this is quite a summary for whatever we discussed just here, and we can see Johnson & Johnson Corporation, they are good at short-term solvency. They can pay off their short-term obligations. They are more liquid. We can see their long-term solvency. They are like their capital is well structured. They have quite good debt, and they can afford that debt. And also we can see their profitability is good. That's driven by their operations. That's driven by their total asset turnover. Their equity multiplier is also low. So at the end, their market value is also fairly valued. It's not that risky. It's fairly valued. So the clear winner from our healthcare industry is Johnson & Johnson's.
Our two top companies for each industry is going to be NVIDIA, and we have based it on the short term, within 5 years. It has a lot more risk, but a lot more profitability ingrained into it. For long term, we went with Johnson & Johnson. It is the best of the healthcare, as well as the fact that it has good, consistent, steady growth. It's not going to be bumping up crazy like NVIDIA will be, but at the same time, if you want something that's going to sit there and keep growing up for 40 years, we believe Johnson & Johnson would be your best bet. For our overall winner, it's of course NVIDIA. We believe that one big aspect to it is also the AI boom going on at the moment. It started in late 2022 and 2023, which would really see it pop off from 2023 for the asset management, the profitability, as well as the, for its asset management and profitability. Really shot up after 2023 and has been continuously growing and doesn't look like it'll be stopping anytime soon. Of course, NVIDIA has a lot more risk involved with it. Should the bubble go anywhere, NVIDIA goes down with it, but AI seems like it's kind of solidifying itself in our day-to-day lives. So as such, we believe that NVIDIA will bring you the most profits, but with a lot of risk.
So
Thank you so much.